Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Verde Agritech stock by analyzing their financial statement and dissecting their financial ratios so we can determine if it's a buy or a sell. Verde Agritech produces potash fertilizers. 95% of potash is used in fertilizers to support plant growth, increase crop yield, and preserve water. It is also used in manufacturing potassium-based chemicals for things like detergents and ceramics. The company is headquartered in Brazil and was founded in 2005. The ticker trades on the TSX, OTC, and Deutsche Börse. Let's get started with the model. This is a small cap company, 415 million market cap. They're trading at $8 a share, and they have 52 million shares outstanding. We're looking at the ticker that trades on the TSX, so all the numbers in this video are Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have negative free cash flow each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that goes up a lot each year, from negative 1 million to 1 million to 4 million to 8 million. Revenue is the sales for the company, and that's gone up 6x from 6 million to 38 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's gone up a lot from 3 million to 29 million. They have really good margins. It was 48% in 2019. Now it's 76%. Gross margin is gross profit divided by revenue. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that was negative in 2019, up to over 10 million in the trailing 12 months. Their operating margins improve a lot each year as well. Negative 16%, up to 12%, to 18%. Currently it's 27%. So they're converting 27% of their revenue into operating profit. They spend 600 million of interest on their debt, which is higher than 2020 and 2021. They don't have much in other income and expenses. These are all the gains or losses not part of the company's core operations. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which was negative in 2019, and it grows each year up to 8.4 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They generated the most cash flow in the trailing 12 months at 2.2 million. They spent more on CapEx, 5.7 million. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow each year, they've been adding debt. They added 5.5 million in the trailing 12 months, 2.8 million in 2021, and 2 million in 2020. They also added 900,000 of stock in 2021. Let's look at the capital structure. 33 million of equity, 9 million of debt. They're 79% equity, 21% debt. And they have a really high WACC according to Finbox. I use the middle one of 11.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 467 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $387 million. We divide that by 52 million shares. And we get a calculated stock price of $7.46. They're trading at $7.99, so they're trading at a 7% premium. It's a sell according to the model. Simply Wall Street says their revenue target for 2022 is 100 million Canadian dollars. And this chart right here is from the company's quarterly report. Their revenue target for 2022 is 109 million. And Simply Wall Street says their revenue target for 2023 is 150 million. Verde mentions in their report they expect to produce 2 million tons of potash in 2023. So you would need to forecast the price of potash and multiply it by 2 million to get their revenue for 2023. And I continued this revenue growth into 2024, and I got 200 million Canadian dollars, and 2025, 251 million. The average company in their industry converts 16% of their revenue into free cash flow, so I multiplied their future revenue estimates by 16%. That's how I got their future free cash flows. This is where the stock has been trading the last 5 years. So it looks like it was pretty flat for a long time, and just in the past few months it's really jumped up a lot. It got to over $10 a share. Now it's back down to about $8. But it was trading well under $2 for a long time. And this bottom chart is the price of potash for the past 5 years. And you could see how much this company's stock price correlates with the price of potash. They were both flat for a really long time, and in the beginning of 2022 they shot way up. So there's not much guesswork when you invest in a commodity-linked business. If the price of the underlying commodity goes up, so does the stock price of the company, and vice versa. Of their 3 mines, one is fully permitted to produce 233,000 tons, another 2.6 million tons, and the third mine is not permitted to produce any potash at this point. They have a really low beta, 0.35, so the stock moves about 1/3 the market. It's gone up 650% in the past 52 weeks, while the S&P is down 8%. The 52-week low is 88 cents, the high is 11.54. And the stock is trading between its 50-day and 200-day moving average. 300,000 shares are traded each day on this stock. Of the 52 million shares outstanding, 39 million are on float. 1/5 of 1% of the shares are held by institutions, and 1/2 of 1% of the shares are shorted. The CEO's annual salary is 411,000 Canadian dollars, and their total compensation package is 2.2 million. In the past 12 months, there's been only insider selling, no buying. It looks like when the stock price really shot up, lots of people wanted to take in their profits. 76% of the company is held by the general public and 24% by insiders. Their employee count has gone up a lot over the years. They had hardly any employees in 16, 17, and 18. Then they added a bit more in 2019, a little more in 2020, and a lot more in 2021. They're up to 250 employees. Here's a list of their biggest shareholders. They're all people that work at the firm. Cristiano Veloso is the biggest shareholder, the founder and CEO, at 19%. Let's look at their financial ratios. Their PE is 50, that's stock price over earnings per share. Price to sales of 11, price to book of 12.5, and we cannot look at their price to free cash flow since they have negative free cash flow. Their return on invested capital is 22%. They don't have much debt, so they can easily cover the interest payments on their debt. They have a really good ROE at 25%, and they have a good current ratio of 1.8, that's current assets over current liabilities, and their quick ratio is 1.6. They lost $3 million of free cash flow in the trailing 12 months, but they do have $11 million of working capital, so it looks like they have enough money on their balance sheet to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 18 companies in the same industry as Verde, and if Verde has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So I converted their CapEx, free cash flow, market cap, and revenue to US dollars, since all the other tickers are trading in the United States. They're a small company, so they spend less in CapEx than the average. They have a good debt to equity ratio. They still have negative free cash flow. They rank 13th in market cap. When you convert their market cap to US dollars, it's 324 million. The average is 9 billion. All their price multiples are worse than average. They only generate 30 million of revenue. They do have positive net income, so their ROA and ROE is positive, which is better than average. So to summarize, I have them trading at a 7% premium, and there's always going to be demand for potash. But you have to think to yourself, is it too late? Is the potash bull run over? Because the price of potash increased so much the past few months, can it go up more? If there's a big crash in potash prices and you hold this stock, then the stock price will also crash. A lot of times when you invest in a commodity-linked company like this, sometimes it's more about timing than investing in a regular company. like Tesla or Microsoft that sells products or services. I rank their free cash flows 2 out of 10, their revenue 4 out of 10, and their ratio 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.